Today's topic is definition, meaning, function, objective, importance, and arguments of financial management. Namaste. Hello, myself, yours. Himalayan soul with ChatGPT gonna explain you. Today's topics, let's begin. Introduction to Financial Management Definition of Financial Management 1. Philippa 2's definition. Financial management is concerned with decisions related to acquiring and financing long-term and short-term resources of a firm. In simple words, it means managing how a business gets money, funds, and how it uses that money for both short-term and long-term needs. Example, taking a bank loan for buying machines, long-term, or using credit for buying raw materials, short-term. 2. Hoagland's definition. Financial management deals with how the corporation obtains the funds and how it uses them. In simple words, finance is about arranging funds and spending them properly. Example, a company raising money through shares and using it to expand its factory. Meaning of financial management. Financial management means managing all activities and efforts related to the proper handling of finance in a business. In simple words, it is about planning, arranging, using, and controlling money to run a business smoothly. Example, a company managing funds to pay salaries, buy machines, and plan future investments. Functions of financial management 1. Financial planning. Planning how much money is needed for business activities. Deciding sources of funds, loans, shares, profits. Example, a company plans 10 lakh rupees for buying new machinery and arranges funds through a bank loan and retained earnings. 2. Financial administration. Managing and using the arranged funds effectively. Ensuring smooth day-to-day operations like paying salaries, bills, and buying raw materials. Example, a business uses part of its funds to pay employees, buy stock, and run marketing campaigns. 3. Financial control. Monitoring expenses, tracking budgets, and avoiding wastage of funds. Ensures profits are maximized and costs are controlled. Example, a company uses financial reports to check overspending on electricity and reduces unnecessary usage. As importance of financial management. 1. Size and composition of fixed assets. Decides how much to invest in long-term assets like land buildings and machinery. Example, a factory invests 50 lakh rupees in advanced machinery to increase production capacity. 2. Managing cash, inventory, and receivables. Ensures enough cash for daily needs, maintains stock, and collects payments from customers. Example, a retail shop keeps 2 lakh rupees cash for emergencies, stocks products for festivals, and follows up with customers for pending payments. 3. Breakup of long-term financing into debt and equity. Decides the right mix of loans, debt, and owner's funds, equity. Example, a startup raises 10 crore rupees where 6 crore rupees is through bank loans debt and 4 crore rupees through issuing company shares equity. 4. Managing short-term and long-term financing. Ensures business has enough working capital for short-term needs and funds for long-term growth. Example, a company takes a short-term loan to buy raw materials and a long-term loan to build a new warehouse. 5. Profit and loss account management. Controls all income and expenses affecting profit and loss. Example, reducing unnecessary advertisement expenses helps a company increase its net profit. Objective of financial management. Objectives of financial management 1. Profit maximization. The main aim is to earn maximum profits in the short run. Focuses on increasing earnings by managing costs and increasing sales. Example, a company reduces production costs and increases product prices to maximize profits this year. 2. Wealth maximization. Focuses on increasing the overall value of the business, shareholders' wealth, in the long run. Considers risk, return, and long-term business growth. Example, a company invests in new technology, which may reduce current profits but will increase company value in future. Arguments in favor of profit maximization 1. Ultimate objective should be profit maximization. Right arrow. Every business exists to earn profit, so it is a basic and logical objective. Example, a retail store aims to maximize sales and profits for survival and growth. 2. Future is uncertain. Since future conditions like demand, prices, and competition are uncertain, focusing on current profit ensures business safety. Example, a seasonal business, like ice cream vendors, tries to earn as much profit as possible during peak season. 3. Profit maximization is rational. Profit is a measurable and rational indicator of business performance. Example, Investors judge companies based on their profit margins to decide where to invest. Arguments against profit maximization. 1. Exploitation of workers and consumers. Right arrow to earn more profits. Companies may reduce wages or increase product prices unfairly. Example: a company cuts employee benefits or uses cheaper materials to increase profit margins. 2. Ignores risk factors. Profit maximization often overlooks business risks like market fluctuations or financial crises. Example: investing heavily in risky projects without proper analysis just to earn quick profits. 3. Profit is a vague concept. Profit can mean different things: gross profit, net profit, or operating profit, creating confusion. Example: one manager focuses on sales profit, while another focuses on net profit after taxes. 4. Narrow concept, ignores social responsibility. Profit maximization ignores social and moral duties towards society and environment. Example: a factory polluting a river to save costs and earn higher profits. Arguments in favor of wealth. Maximization 1. Timely payments to short-term lenders. Companies focused on wealth maximization ensure short-term creditors are paid on time. Example: paying suppliers and vendors without delays builds trust and good business relations. 2. Fixed returns to long-term lenders. Long-term lenders, like debenture holders, get assured returns through interest payments. Example: a company pays regular interest to its bondholders even if profits fluctuate. 3. Employees' share in wealth increases. As the company grows, employee benefits like bonuses, incentives, and job security improve. Example: employees receive profit-sharing bonuses when the company's market value increases. 4. Efficient use of resources. Wealth maximization ensures all business resources are used productively and economically. Example: investing in automation to reduce waste and increase output, leading to higher business value. Profit maximization versus wealth. Maximization point. Profit maximization. Wealth maximization main objective, earning maximum profit. Increasing company's market value, focus. Short-term gains, long-term business growth. Time value of money ignored, considered. 1 rupee today is more valuable than 1 rupee in future. Risk and uncertainty. Ignored, properly analyzed and managed. Dividend policy effect. Not considered, considered. How dividends affect share prices. Function of financial management. Functions of financial management. 1. Estimation of capital requirements. Figuring out how much money the business needs for short-term and long-term operations. Example: a company estimates it needs 50 lakh rupees to launch a new product line and run operations for 6 months. 2. Determination of capital composition. Deciding how to arrange the capital. How much from owners' equity, and how much from loans, debt. Example: out of 50 lakh rupees needed, 30 lakh rupees will be taken as a loan, and 20 lakh rupees will come from shareholders. Third choice of sources of funds. Selecting where the money should come from. Banks, investors, debentures, retained earnings, etc. Example: the company chooses to borrow from a bank instead of issuing new shares. 4. Investment of funds. Using the money wisely in profitable projects and assets. Example: the company invests in buying new machinery to increase production capacity. 5. Disposal of surplus. Deciding what to do with profits. Reinvest in the business or distribute as dividends. Example: a company earns 10 lakh rupees profit, it distributes 4 lakh rupees as dividends and reinvests 6 lakh rupees in expansion. 6. Management of cash. Ensuring the business has enough cash to meet daily needs and avoid liquidity problems. Example: keeping enough cash to pay salaries, rent, and utility bills on time. 7. Financial controls. Monitoring financial activities to ensure efficiency and prevent fraud or waste. Example: conducting audits, budgeting, and using tools like ROI, return on investment, to track performance. Thank you, like, share, subscribe. See you in next video.